Most businesses have pretty wide varying beliefs about how long COVID's going to last. From a few months, the effects of COVID are going to last in the economy from a few months all the way through to, multiple years. And just, between us on the call, the Moneta team has done an internal survey of what we think is a likely scenario. And we did a, survey across the 5 partners and came up with our idea that 60 to 80% normalcy in the economy will be reached by September of this year. So we're anticipating, 60% to 80% consumer spending, workforce, et cetera. We should see an uptick. This is barring a significant second wave of coronavirus coming through, closing down the economy again. But just to get an idea, that's kind of where we landed. This was done in March. So I guess, 6 months was kind of our prediction across the board. The fourth point here, through the CARES Act and the PPP program, most of our portfolio companies and many others have taken advantage of those forgivable loans. A lot of people felt that there's going to be bureaucratic hurdles, but depending on which banks you work with and so on, that has actually been less of an issue for many local businesses that have worked with regional banks that have gotten their loans funded in a matter of 2 to 4 weeks. So that's been pretty great overall. So that's the Harvard study that I'll share later. Just a quick example of how some businesses that we've seen are adjusting to this world, from retail businesses and brick and mortar shops that have now been forced to jump into e-commerce. Some of the challenges there is that, slow to pick up online to get an online presence and customers coming in, but it's offering loyal customers a way to shop at the stores they used to be. For those that know any brick and mortar sites, I would direct them to Shopify, which we have zero, interest or relation to, but are offering a 3-month free trial to get, their customers up and running on the e-commerce shop to handle, orders, fulfillment, et cetera, which I think is a great resource. Many companies are partnering with third-party delivery services to add, they just pass on the cost of delivery to their customers for $5, and we'll be able to have, gig economy workers pick up and drop off physical goods. Most people are going to some kind of curbside pickup. Service businesses obviously are a more difficult industry to adjust to without face-to-face contact, from any home services to realtors, et cetera, having a tough time. Those that have a teachable skill, I've seen some very successful people that use Patreon. Patreon's like a monthly subscription service where you can be a patron to different service providers, and they will give you exclusive content, whether that's people that blog or vlog, to providing lessons from musicians to, different services that you can get a, monthly income from that, or Udemy classes. I've actually explored that myself to help, startups get some venture funding classes done virtually when we can't meet in person. So that's kind of the big one. And the other 2 points here, are not necessarily useful because they're just things that we've seen people do, but I think generating revenue obviously is the name of the game, and that's some ways using service providers pivot. Tech startups as a whole, and this is across our portfolio as well as other companies I talk to, have been taking some steps, and I'll cover this more in detail, but the obvious one is kind of slowing or pausing hiring and reducing headcount in non-essential roles. And so typically that has to do with redundancies in engineering or other types of roles where you have, a second or third string to work on future projects, which is not necessarily of importance right now. And sales and marketing personnel. I caveat that by saying not all sales and marketing spend. You don't want to fall off the face of the earth when things return to normal. So maintaining some level of top of mind with existing customers and future customer base by spending money on sales and marketing, we feel is still important to whatever degree you can, but reducing redundancies in sales and marketing personnel. If you're in the position to raise interim financing through a variety of instruments, we've seen companies do that. To add anywhere from 3 to 6 months of runway at their last round of funding, that valuation price or any other types of financing they can get a hold of without thinking about doing an up round and valuation just to extend the runway. And the third piece is pivoting to focus on customers that are either less affected or positively affected by COVID. So some industries that have seen an uptick in revenue or customer acquisition are medical service companies or med tech industry companies, which we have a few of in our portfolio that are seeing increased demand. So pivoting some of your go-to-market strategy or businesses to assist those companies that are getting more revenue to spend would be another way that some of our tech startups are pivoting. So I'll jump into the part that I think I know relatively well, which is what are the VCs thinking during this time? One of my friends at Industry Ventures had posted a survey of 117 VC funds and what VCs are thinking is going to happen in this economy right now. So I'm going to go over some of those statistics that he pulled from there. So across the board, one of the first questions was how significant has this impact been on a fund's net asset value? So when funds value their portfolio, they have each company that gets valued and they roll that up into the overall net asset value of the fund. Over 50%, so 55% have said there's a moderate negative impact already. This is done in April already on their fund portfolio. So that would anywhere from 5 to 15% annualized return drops, in my opinion, would be considered a moderate negative impact already seen across the way they're valuing their companies. But a bulk still know that there's not much data to be able to tell right now. Some of this is a scare factor, sticker shock. So this is taken lightly. When these companies are valued on paper, in good days they're marked up, and bad days they're marked down. So just taking that with a big grain of salt, keep that in mind. But most funds do feel there's some negative impact already. For surveying the general partners at funds, a overwhelming majority feels that the U.S. economy is entering some sort of recessionary period. Again, this is one asset class's view of the world. This is not a typical recession brought about by typical macroeconomic conditions, but something to keep in mind that most VCs feel that there is a recessionary period that we're about to enter into. And how long do they feel that this is going to last? The bulk, more than half, feel that it's greater than 7 months, with the plurality feeling 10 to 12 months or longer. We're probably in that exact same bucket, about the 7 to 9 month period or 6 month period, but very few people think that it's not going to last longer than a quarter. And I'll send this report out to Jeff and Laura so they can distribute it as well. There's some more questions that they asked, VC specific. In terms of how VCs are deploying cash, depending compared to exactly 1 year prior, the bulk are seeing, again, some level of decrease. I'll talk about how we bucket this in Moneta, but over 50% are seeing, somewhere in the 0 to plus 25% decrease in investment pace. So either in terms of capital deployed or number of companies invested in, that number has reduced materially compared to 1 year ago. And this is not, this is not data point based. This is just to illustrate. If you think of how VCs deploy capital or in what companies deploy capital in, we can put together a bell curve of many VCs that invest in kind of this middle of the road area, which is, some of their companies are going to be slightly higher growth, but, higher burn. Some of them are going to be slower growth and profitable companies. This would be a typical bell curve, let's call it, for traditional venture investing across all stages. What's happening now is that bell curve is shifting to the right across the board. So the bar is significantly higher for companies to not be, hemorrhaging cash on a monthly basis, but moving toward profitability, profitable unit economics at the expense of hypergrowth. And, we at Moneta would probably concur with that being our focus with companies right now. If they have cash and they're able to grow fast and get some low-hanging fruit, go for it. But most VCs will expect companies to, cut down on monthly burn at this point. This is something that's a data point for people to just understand about VC returns as a whole, pooled over a 10, 20, and 30-year period, taking into account previous recessionary periods, booms and busts, and how early stage venture capital, according to the Cambridge Associates report, compares to other types of indexes. It's pretty standard on a 10-year period that people say, VC as a whole is not a great investment class for whatever reason, is pretty standard. But when you look at it over larger time horizons, it actually becomes a pretty compelling case for early stage VC to outperform many of the other indices that we see. big portion of this has to do with, a handful of companies and a handful of VCs that really have outsized returns, but as an asset class is a compelling statistic. The other last data point on VC returns, which I always found interesting, and I didn't realize this until, probably 3 years into working in VC, is the reason that investors invest in venture capital is that it's very similarly to real estate, a hedge against the public equity and bond markets. So if you think of, correlations to the equity and bond markets on a scale of -1 to 1, with -1 being when, public equities and bonds go up, the VC market and real estate market goes down. Positive correlation of 1 being when it goes up, there's a 1-to-1 correlation and it increasing. There is actually almost no correlation, which means that you cannot draw a direct 1-to-1 ratio with what happens in the equities versus, venture capital. Very similar to, real estate. It could be a lagging or leading indicator, but there is no direct correlation. So just something to keep in mind about how VCs view macroeconomic trends as it relates to their investment activity. So the takeaway for everyone to how VCs view this is I've spoken with probably 25 funds over the past 3 weeks just to, discuss what they're doing, how their funds view it. And I have managed to kind of put them into one of 3 buckets. I'd say the larger funds with a lot of cash on hand, are business as usual, no change in investment scope, or they're actually picking up investment pace to find good deals, lower valuations, and so on. Bucket 2, which I think that Moneta falls into, and most medium-sized funds or funds that are farther through their life cycle of investing, their bar for investing in companies is much higher. So, we typically say our minimum threshold is $500,000 in annualized revenue. That bar might be doubled for us to feel just as confident in investing in that company to de-risk the enterprise. So the bar is higher for them to make the same investment. And some funds that are just not investing at all till they know what's happening in the world. And so I'd be happy to answer fund-specific questions, but that totally depends on how each fund operates. And so I think I've seen some questions on the chat. Laura, I'm just gonna defer to the questions to later and maybe have you help me moderate those to finish after I get through this, which is just now. And so that's pretty much all I had on the VC takeaway. I kind of wanted this to be a generally casual question and answer. I'll try to be as transparent as possible without giving any buzzwords or other answers that people might be used to hearing. So we'd just like to open it up for questions across the board. Please think of them. I will go ahead and look at this first question that was asked from Nick, saying, can you walk through your lens? And sorry, go ahead.
I was going to say you could read it or Nick could ask it. Nick, do you want to?
Yeah, Nick, well, yeah, go ahead and open it up for Nick to ask if he's able to.
Sure. Can you hear me?
Yes.
Yep.
Perfect. Yeah, so I was just curious, especially when we look to the Sacramento region, one of the largest gaps we've historically had is kind of seed and angel investment markets. I know Moneta's kind of on that precipice of kind of post-seed, pre-series A for kind of that first check size as well. So I know you sit a little outside of that, but, kind of what you see right now is that a lot of angel money is kind of coming off the table, of course, due to their own portfolios being hit via the stock markets or however they're divested. How do you see that ramification kind of, playing a little bit more forward? Because, you definitely see a little bit more reserve positions from venture funds. And I think you broke it down really clearly in terms of, depending on where they are in their fund cycle, if they have to raise a new fund, they're definitely going to be more in a reserve mode. If they've just raised a new fund, there's going to be a little bit more of an opportunity to still deploy. But kind of when it comes to angel and seed in the Sacramento market, one of my biggest fears is that it's going to be essentially another large gap for about 18 months because it's essentially drying up. So just kind of curious on what your thoughts are and how do early stage entrepreneurs kind of deal with that moving forward? And then B, are there opportunities to rebuild the seed market, especially in the Sacramento region? So a little open-ended.
That is an awesome question. And so starting with the premise of the question that, we have a traditionally weaker seed or angel investor network than, let's say, tier 1 cities or the Bay. I would agree with that assessment. I think that, the groups that we do have are incredibly active and engaged with the companies, SAC angels who we're a member of. It's just that the dollars that are available are much, much lower. So less dollars to go around. So traditionally that's the case. And are they impacted by this, largely so. So I like to segment, angel or seed investment from individuals into a couple buckets. There's the, I'll call them hobbyist investors to start with, which are, people that are accredited investors, but will be investing smaller checks, typically, $10,000 to $25,000 checks into a variety of companies to just get their feet wet with angel investing, or, semi-retired and enjoy doing that, which are traditionally, folks that, have some assets, but not necessarily high net worth individuals whose portfolios might be directly affected by this, and they want to save cash and not invest with these dollars. I'd say that's the bulk of most traditional just angel investors. That's definitely affected. Whether it's 18 months or not, I'm not sure. I would say the larger super angels, or folks that are almost quasi-family offices in the way they invest, typically assets ranging from 50 to hundreds of millions of dollars, that have asset managers that work in-house diversifying for just situations like this. Those that are more sophisticated investors might look at this as opportunistic, to my previous point that, hey, they're not going to be investing in the way they traditionally did. They're going to look at alternative assets, of which early stage companies are one of them. The scrutiny is much higher. And so I guess the short response is yes, it's very difficult now to go raise angel investment or seed investment. The way that I would say, I caveat that is, if your company is doing something that is either unaffected or positively affected by this, distance learning is one of them. I know Barb's on the call right now with Sama Learning, right? So there's opportunity there for distance learning and virtual learning, where investors might be more interested in that. I think I introduced Barb to a company that's focused on EdTech, who is looking for exactly these opportunities for looking at businesses that are in education that are positively affected. That's definitely one sector. Remote work in general, healthcare, telehealth, things like that are opportunistic. I think they're jumping in on. So to answer your question, there's stuff that's not affected right now. There's the bulk of typical tech startups or small businesses that are definitely going to have a tougher time finding investment from angels. And then there's that group of, ultra high net worth super angels that would still be looking for deals regularly because their asset base is just large enough that it's diversified and they can continue investing. Does that answer your question somewhat?
Yeah, definitely does. I mean, super helpful. I appreciate it.
Okay,
Okay,
other
great.
questions? Carolyn, go ahead.
Yeah, hi, it's Carolyn Peer. Can you guys hear me all right?
Yep.
Okay,
Yep.
great. Question, way to get more efficient. I'm wondering, Sabya, if you have any tips around.
Can you say that again, Carolyn? Sorry, it cut out just for a second on my end.
Oh, sorry. You can hear me, right?
Yeah.
Yes.
Okay. I was wondering if you had any suggestions or tips on how to get more efficient in talking to the VCs and investors out there who are still, they've got plenty of dry powder, they're in the game, not just focusing on their existing portfolio companies, but in the cycle of their investments, that they're still active with looking for new investments.
So are you saying how to find them?
Just how to find them more efficiently. I feel like, maybe I'm hoping this will help other people here too, but the kind of one by one talking to them is just really inefficient. And what I'm seeing is it's really all over the board. Some are like, oh no, now if you're in the right space, the right time, let's talk. And others are like, no, Carolyn, come back in 6 months. It's just, I feel like it's a very inefficient process. And I'm wondering if you have any tips on how to get better at that, so it's not wasting other people's time nor my own.
That's a great question. Yeah, completely makes sense. I mean, the one-by-one approach it works when you have warm introductions to funds, right? That's another fund will almost always take an initial meeting if it's introduced by one of their previously syndicated partners or another VC in the network, because there's some level of vetting that happens there. So I know this is probably not the easiest answer to the question, but one is just asking investors or folks for introductions to funds. In that point, the one-by-one intros make sense. You have a higher hit rate of landing meetings. For cold outreach, rarely does that ever, work as well. I'm sure just reaching out to funds with a deck or request for a meeting often falls upon deaf ears, and that's just due to the volume of inbound requests compared to existing pipeline from our investors themselves, co-investors, and so on. So to answer your question on how to efficiently find them. So I was just gonna, try to do this live if possible. Let's see.
And just for clarity, I mean, figuring it's not so much about warm intros or cold outreach, which I agree with you. It's cold is much less efficient, but the stage that the fund is at, where they're still active even in this COVID-19 world.
I understand.
Okay.
And so let's just get to that point then. Is CrunchBase, and I pay for CrunchBase Pro. It's not the most detailed or has the most data, but does take into account activity. So with the Pro feature, you can go and do some pretty good queries. And I know you can sort by funds, but let's just look at funding rounds, for example, and date announced is one example. And see if we can sort here. I'm not sure, but there's a way to get into an advanced query here with CrunchBase, where we can say, you're looking for funding stage is seed, for example. We're going to sort it to that. And so we're going to look at organizations. Let's see if we can add I know I'm doing this live. So let's add the investor column here, see if that works. Investor names that have invested in seed rounds sorted by date, for example, right? You can export this to CSV or something, but doing a somewhat data-driven approach like this, you can even, I think, add in size of round somewhere, maybe money raised, for example, less than whatever you're looking for. If it's $2 million, and use that. Right now we're down to 60,000 funding rounds. We're saying these are sorted by date, and looking through this. Is descending the right one? Yeah, we can look through who's investing. You can probably sort by geography, by sector, all that, by building out some kind of queries. I actually do use this, but figuring out who's raised how much money. Some are, this looks like it's in, I don't know what the R dollar is, and this is India, for example, in rupees, probably not the right one, but sorting
Brazil.
By, is it?
The R? Yeah, it's reals.
Oh, I meant this one right here, this 50 million down here. But in any case, I mean, sorting by, USD, maybe in California or something of that sort by industry would be a good way to just figure out who's currently investing in rounds. It's probably the more data-driven approach. Other one is using, I don't like Gust personally, but for angel and seed, it's not a bad deal flow platform to go find investors, where you can, fill out your company profile and reach out to, I know SAC Angels probably use Gust, but fill out your profile and look at angel investors, create one profile for your startup and invest and apply to a bunch of them. I don't personally use it, but I know folks do. But looking at stuff like this, CrunchBase is probably the only affordable data source, but finding those investors is one method of going about it. Did I answer your question to some degree, Carolyn?
It did. Thank you. Yeah, I've not used CrunchBase Pro, just CrunchBase. So that was a good insight. Thank you.
Do you know how much it costs, Sabya, to upgrade to Pro?
I'll tell you right now. It is $29 a month.
Okay. So while you're fundraising, which hopefully isn't for 5 years, well, at least not 5 years for one round, could be useful. The SAC Angels do use Gust. That's how you apply. Also, I wanted to mention, and it's kind of a question for you too, Sabya, like pitch events. What's happening in this realm of we aren't meeting in person. I can tell you that the SAC Angels are doing their periodic investment meeting via Zoom. So it still makes sense if you want to present to the angels, to apply to them, and they meet about every 6 or 8 weeks, taking a couple months off in the summer. And I know a lot of other groups that I have exposure to in the ACA, Angel Capital Association, I think is what it stands for, have gone to doing their investor meetings via Zoom or a similar platform. Do you have any?
Yeah, so the first question about pitch events, It's definitely easier for more investors to attend pitch events virtually. I think the friction is lower. I'd say that it's a good method. That being said, because the friction is lower, you also get a lower hit rate overall from investors that are interested, because you're not in person making those contacts and so on and so forth. So two pieces. I mean, I definitely recommend it if you can be a part of an accelerator program or cohort. The cost to do that is reduced now, and I feel like there's more spots open because there's less people vying for them currently. So I definitely recommend trying that. I think it's a great idea, Laura. I'm assuming that most people that are asking this question have probably done that in the past and either have gone through it or have not been selected. But I think that, doing it virtually is best, great time as any to try it out without having to relocate to the Bay or other places. And so I'd say about virtual demo days specifically. Is that kind of what your question was?
Not just demo days for accelerator programs, but even pitch events. Like I think there was one this week. Jeff, do you remember that organization that's always sending us emails? They have like 100
Which one?
attending.
Startup Blink or something like that, maybe?
Maybe, or the something West, whatever. But I get emails showing that these pitch events are still happening. But like Sabya, I mean, they're not necessarily associated with a cohort, but it might be a chance for you to get out there and at least practice. I agree with Sabya that it doesn't have the same friction, because a lot of these things, it's meeting the VC in person that can help. But there may be something to take advantage of. The prices to participate are way down from what they used to be, or even free in some cases. So something to check out.
I would say that, I personally am not a huge fan of demo days as a slightly later stage investor. But I think for non-institutional investors, it's a good source of deal flow. So I would apply. I'd say if you have to put in too much effort to be a part of it, don't do it, because it's way too much effort for the value you get out of it. If it's something that you can apply and present your canned pitch at, and it's a low-hanging fruit, go for it. So that'd be my response. Nick has a question, but also did have a great article, a great link here that he sent out about VCs that are selectively investing. I think that's awesome. And I believe that there's probably multiple of these. If you look, there's lists available for startups that are still hiring across various roles. There's lists available for VCs investing. So I think a little bit of Googling or looking at tech related publications would be useful to find those lists. But Nick, did you have a question?
Yeah, I appreciate it. So, one of the things you hit on is I think you're dead on in your read that most Series A funds are probably going to switch their metrics for investment. So in your example for Moneta, it's probably moving your ARR probably at a 2x, right? 500K yearly to about $1 million. What other metrics do you think are going to be pretty large? As we talk about the growth, certain businesses are definitely going to have higher inflection growth. Like I think, as you note, edutech, you're going to see some, virtual conferencing, et cetera, to the left and the right. But the element that I'm more interested in is that, a lot of these other businesses are probably, having slower growth as they move for profitability. So do you see in your guys' case at Moneta maybe moving or blending your values in terms of core metrics for investment from, say, ARR to, say, gross margins or net margins? Because growth might be slower, right? But at least they're more profitable, where, you're seeing 40% net margins, or, is it LTV analysis? I'm kind of curious on how you triangulate that picture, because, ARR is just one slice of the element. And, if you're doubling it during a recession, you're probably going to have a lot lower amount of investment opportunities in general. So are there other elements that seem like a more ripe disruptive opportunity for you guys to invest that might not hit the 1 million ARR threshold, but might paint a more exciting picture that you guys would want to jump in on? And what would that look like for you guys if you were to carve out that?
That's a really good question. There definitely are different metrics. I'd say for us specifically, there's an ARR threshold after which the other metrics could take into account, right? But that threshold is almost a bare minimum, and a lot of funds don't have that. Actually, I think we're in the minority in the funds that I've talked to that has a hard threshold. Many more will invest across different stages without any thresholds. So to specifically answer your question in terms of what other metrics. So when we think about it right now, people don't want to be spending a ton of cash for future value that they can't see at this point. In the past, that has been less of an issue. User acquisition, customer acquisition, with upside down margins have been okay because we'll make it up in the future at scale, right? That has definitely changed now to more profitable unit economics, even at a smaller scale. So to your point, I think slower growth is more okay now than it has been in the past. But the key metric I would say across the board would be, unit economics as it comes to customer acquisition versus, like you called out, lifetime value. Most early stage businesses don't have an idea of their LTV analysis, right? It's like, it's all based on some assumptions. So I'd say forget LTV for a second, but discussing customer acquisition cost and coming up with creative ways to get customers has been, something that we've, seen positively. We have a telemedicine company in our portfolio that is now looking at influencer marketing to get, telemedicine solutions in the hands of consumers, right? You never think of telehealth going down the route of influencer marketing. So coming up with creative solutions that allows them to reach a larger customer base at a lower cost is probably the first thing, right? So the stage that we invest at is less R&D. So we want to invest in growth. If you're going to invest $1 million, we want to see it go towards something that's going to drive top line or bottom line. That's going to be lower customer acquisition or higher ROI for each customer acquired. So that's going to be, one of the primary metrics we'll look at is profitable customer acquisition. Otherwise, I think it definitely varies. We're not a consumer focused fund, so I can't go too deep into, user acquisition metrics or, average revenue per user and stuff. We typically don't track that, but I think other funds would be looking at, that being something that they can do at a lower cost or find ways to upsell their existing user base as opposed to going after new users. There's going to be metrics like that that become more useful, right? If it costs them $50 to get a new, customer versus they're going to be able to increase revenue for existing customers by $5 by spending a fraction of that amount, that becomes more compelling, even though the user count is not going up. Does that make sense?
Yeah, no, it makes total sense.
Yeah. Okay.
Perfect. Just a quick follow-up question, just as a small note. Just curious, do you guys have, kind of as you see this move into COVID and probably, physical pitch meetings not happening for a decent amount of times, you're seeing this move to virtual, which of course has certain pros and cons. I'm curious, have you guys ever considered or been open to, say, rather than using the traditional venture deck, evaluating investment memos at kind of the Series A stage, similar to what Rippling did for their Series B? I'm just curious, does that seem more appropriate now because storytelling might be a lot harder via virtual meetings, that you might need to actually send a compendium 5-page memo that outlines the investment? Is that something more beneficial for your lens at Moneta, or is that something that's still to be determined, or maybe not as valuable at all compared to, say, a traditional deck and pitch?
Yeah, no, a good question. And I don't know other funds. I can't speak for them. For us, it's definitely been the same as it always has been, which is we typically ask for a short form of some kind about the business, whether it's a 5-page overview deck that has some key metrics and business fundamentals about the company, or a 1 or 2-page executive summary, not really a memo. That gives us enough content to go into the initial meeting. So to your point, yeah, it's very difficult to make an investment not having met someone in person. We're actually, this is not yet announced, but in very late stages with the company that we started talking to, I think late December, early Jan, actually based in Sacramento, and we're set to do a tour of their office and meet in person. All that got put on hold, and now we're doing everything virtually. But the process has not changed from sharing a deck, financials, creating a data room, et cetera, has been the exact same. So that has not changed. I wouldn't recommend, having to create new types of material or fundraising material to go after VCs. Typically, they'll ask you for what they want. But I'd say the bulk of them are going to look for a short form deck or executive summary, a long form deck that's either presented in person or viewed over email, and then any supporting material, financials, cap table, et cetera, that's presented in the exact same way. Investment memos are mostly created by the associates or analysts at a fund that takes their lens on the meetings that they've done to present to the partnership, but not something that they typically require you to create.
Got it. Super helpful, man. Thanks so much for the time. Really appreciate it.
Of course.
Okay, anyone else have a question they'd like to ask? Okay, I will ask a question. I'm curious who on this call is fundraising and what round? So Barb, you're fundraising, yes?
Yeah, we are. We had just started more aggressively looking at doing a seed round, and we're working on the deck, really revising or expanding our approach to the market. And the place we were at was my goal was, 20 pitches in 20 days. I really wanted to get the pitch down and get feedback on it. And so we were in that process when all of this happened. Because our primary market or initial market was, so our shift really was, we were focused initially on higher education. We expanded that to more workforce development, career technical education as well. And so now all of the fundraising conversations we've had have stalled. Sabya mentioned the conversation, the introduction that he made for us, which was very helpful. Although I'm not sure how, it's always a question about, I'm like a taskmaster. If someone says they're going to contact, they're going to follow up, I try to, keep that going and follow up and close it. And so like, this is an example of someone who I thought I had a really great call with. The whole shift in, as Sabya mentioned, to online learning and virtual learning really fits well into what we're doing. It's what we believe in. It's, the whole opportunity to rethink how we're approaching education and teaching and instruction is ripe for what we're up to. Thought I had a great conversation, said she'd contact me on Monday, no word back, followed up on Wednesday, still no word. So it's like, okay, well, I just kind of, I guess, close that book. Or like one of the questions I have is, what do I do? Right. Just.
I mean, I totally sympathize with you, and I'm guilty of the other side of that, other side of the table of, I get so many, not even inbound requests for emails, but right now about 20 hours to 30 hours a week are spent on portfolio operations, right? So like I have just 4 to 8 hours a day booked off with various portfolio companies on
that's helpful.
Business planning and other stuff, right? And so it's like literally my inbox will be on hold for 4 to 6 hours, which I usually is not. And stuff will either get lost or snoozed or something or another. And so honestly, there's been times where it's like the 4th follow-up that I've just been like, I'm really sorry, book time on my calendar to follow up and send them a link, right? And that's just the nature of this. I mean, I think we could all be better at it. And if we had, EAs managing us and we had more money to spend, it'd be easier. That not being the case.
Yeah,
completely. And I just now, especially because like I think most VCs that are operators, not just investors, are doing what we're doing, which is a lot more portfolio operations, weekly board thinks and calls, investor calls to kind of constantly gauge and reevaluate. So to answer your question, what should you do? I mean, I would first of all not be disheartened and reach out consistently with a pretty neutral tone, neither optimistic nor pessimistic.
Yeah.
And always, I mean, after maybe the 3rd try, I would just say, hey, like haven't heard back, just going to close the book on this unless you'd like to continue talking. That's usually enough to just, I'll tell you personally, elicit a guilt response for them to be like, crap, I feel really bad now. Let me schedule some time, or let them know that, hey, we're definitely not investing, right?
That totally makes sense.
That'd be my honest way to look at it.
And like for me, it's really more about, should I be putting any energy in fundraising right now? Like because I think, like you said, like what we're doing fits really well into the future of what we're, this whole situation just exemplifies the value of what we're doing. But I don't know how much to push on that, or should I just say, look, we're not going to fundraise right now. We're going to find a way to scrape our way through. We're going to grow much more slowly. We're maybe not going to be able to realize the full benefit of the situation we're in right now and what the market, I just don't know. I just don't know what to do. I don't know which direction to go. And usually I'm pretty good instinctually at understanding that and getting a feel for that. And right now I just don't have a sense of that at all. So
I think typically VCs don't want to fund people that need to be funded right away, right? It's like it's always the flip side where they want to fund people that don't need the money and fund it for growth and all that fun stuff where we're really hypocritical. I would say, if you're in a position to not have to raise money, don't. But if it is an opportunistic deal for very strategic VCs, whether it's in ed tech or remote learning or something else, or angels that are interested in that, I would, go full force and just reach out, have someone put together a marketing list or a hit list and just send a quick 2-line, 3-line email that comes from you with an overview, or just friendly funds that just saying that, hey, like we weren't originally going to raise, but because of the current situation, we're seeing a lot of inbound interest or an opportunity for us, and looking at raising a small round to just expand and grow in that, right? VCs love scarcity value. I mean, that's more than anything. It's really the FOMO that gets us interested, right? So if there is a scarcity value and inbound interest, I would say go for it. But I wouldn't ever go down this road and say we need to raise money to survive, because no one's going to be interested.
Yeah. That's what I feel like. It's like, let's just keep moving forward on what we're doing. And as the opportunities for that come up, then we'll go after that. Yeah. Thanks, Sabya.
All right. Brad has the next question.
Hey, Sabya. Thanks for doing the call today. Great information.
Hey, Brad.
Cool. Quick question just around styles of investing. Have you seen in your calls with other VCs sort of a shift in terms of maybe doing more venture debt investing versus equity, or different styles in terms of going convertible versus safe notes, just from people being a bit more risk adverse in terms of how they invest, or changing their approach in terms of type of investment specifically?
So as of now, haven't seen a change in terms of, investment vehicles like you're suggesting. I think that it's probably too early for folks to completely change their style of investment. The most VCs are kind of swinging back to lower valuations and pulling different levers like, liquidation preferences and things like that to enable them to have more downside protection in their investments, as opposed to changing to debt. We do some venture debt type stuff, which is, lower interest than, credit cards and with some warrant kickers, but that's not a majority, and we're not swinging to that direction because, at the end of the day, the reason that we'll do debt is to collateralize our investment with some assets, and most companies we look at don't have any that are worth collateralizing. So we typically don't change our focus. In terms of the convertible securities or convertible notes instead of equity, VCs that usually invest in notes are typically investing in notes. Those that do equity are still investing in equity, but lowering valuation caps, maybe increasing some interest rates or discounts, and for equity folks, reducing valuations across the board. That's probably the general consensus right now. But I do think that, if things continue the way they are for 3, 6, 9 months, there's going to be VCs that are going to come up with more punitive terms in their investments, which are going to be notes with, quicker maturity dates or prepayment dates and stuff like that are going to start coming into effect. But I think it's too early for that to have been a quick shift already.
Yeah, makes sense. Thanks. Appreciate it.
Okay. Do we have other questions?
Yes, this is Dick Flask. Following up on that last question, we're a Calci concept awardee from last year. We're competing for the Calci prototype award this year, and that's a $450,000 grant based on reimbursement. If we win that, we will probably need some kind of financing to cover the cash flow. And I was looking at the possibility of convertible debt. So with a backup like a Calci grant, does that make convertible debt any more likely to be captured?
So I'm not familiar with the grant itself. I'm assuming it's just non-dilutive funding from a governmental agency. Is that correct?
Yes, it comes from the California Energy Commission. It's non-dilutive. It's just a grant for developing toward commercialization, but the payments on the grant are based on reimbursement. You have to spend the money before and invoice them before you get repaid for it.
It's
So
cash flow issue. It's a cash flow issue.
yeah, it's a cash flow issue. I mean, we were able to in the phase 1 grant, we were able to just internally handled $150,000, which was, a cash flow problem. But if we win the second phase, that 450 will definitely need some type of financing for, to cover that cash flow. So,
sure. So to answer your question about convertibles, I mean, a convertible instrument of any kind is just another way to take in investment, typically used at earlier stages or for smaller rounds. It's typically cheaper from a legal standpoint to get, convertible note ready with a bunch of smaller investors. If you're going to raise money from VCs, typically will not do convertible securities. They're a single investor that has the ability to just do an equity round of funding. But the general question you're asking, is it easier to raise money if we have a grant? The answer is usually yes. Typically grants are going to help cover the R&D or content development, whatever it is, engineering type of costs, and you can invest the equity money into sales and marketing efforts. So we like to see that non-dilutive funding depending on the terms of what the grant entails, and if it restricts your ability to raise money and stuff like that. As long as all those boxes are checked, generally it is easier to raise money if you have more free money available, right? Especially if it's used just to cover cash flows. So my general answer is yes. That reminds me of a local Sacramento business called Agaria. They started a new product called Open Grants. I'll just send this link out here. I'd encourage you guys to check it out. I just talked to Fidel, who's their CEO, this, I think Monday or maybe Friday, about what he's doing, but trying to open up easily accessible SBIR and STTR grants for companies that are focused in a variety of industries. But what he's done is aggregate them into a searchable database that abstracts the grant requirements and the overview, but provides what you're talking about, Dick, pretty much the 150K plus additional follow-on funding. And so the Laura just mentioned also Comstock Magazine, Startup of the Month. So definitely check out them as an alternative source for grant funding. And I would put that as a piece of your fundraising material when you talk to folks, is that we do have this grant money. I would recommend that you don't try to source capital purely for cash flow purposes, but rather for additional growth. The way that it would be, the narrative would typically be said is that, hey, we have this grant to cover our, one-time R&D expenses, and we have this equity or debt capital to fuel sales and marketing or other development. That's typically what investors would like to see.
Okay, thank you.
Okay, we have time for one last question. Anyone? Bueller? All right. Sabya, could you tell us about your one-on-one office hours that you're offering?
Sure. I don't know if you have a link to that, Laura. I'll send that out afterwards to you to distribute, but just been spending half an hour with anyone that's interested, just, free of charge to discuss any part of the business or specific item that you would like to cover, primarily just from an investor's perspective or also general business planning, business modeling perspective, early morning or evenings throughout the week. And I think maybe Saturdays. I'll send out a link to my calendar. Feel free to schedule that. What I've said is that don't schedule it if you're looking for funding from us. Just schedule it if you have questions. If you're looking for funding from us, please don't do it. Just send me an email and I'll tell you if we're interested or not. But for anyone on this call or any of your, colleagues or associates, happy to just schedule those type of discussions.
So it's coaching, basically, mentoring type.
Pretty much. Mentoring or even just review of your pitch deck, pitch materials, whatever you want to do for other investors, happy to do that.
Okay. And that's
I'll just put the link here actually, so we have it. I believe this is the right link.
And I'll send out an email to everyone who registered that includes, Sabya, you said you had a report you're going to give us, and I'll also include the link to this. Might not be till tomorrow that I send that, but it will be going out. Then, Sabya, was there anything else you want to say before we move on to a couple of announcements?
No, I mean, I think I covered everything. I mean, I'm happy to answer questions offline, or you guys can schedule time to chat. If you have any questions you don't want to ask in the public forum, I try to be pretty transparent, so happy to do that. But nothing else to add. I actually have to hop off as well for a call. But Laura and Jeff, thank you guys for putting this together, and hopefully we can do more of these. And everyone else, thanks for your questions.
Thank you, Sabya.